say, hey, hypothetically, in May of 2019, right here, we had some money and we bought 25 shares of Apple at $44.64. Okay. We had some money, so 25 shares. I got a calculator here. I'm a former English teacher too. I have no math background, just so everybody knows that. All right, 44.64. So $1,116. So we had some money on the side that we got from our tax refund, right? So in 2019, we bought 25 shares of Apple. And we just said, hey, we're going to sit on this. Okay. And that's what we did. We bought Apple, we sat on it. And then here's what happened. Oh man, Apple started to go up. We're feeling good. And then it came down, right? And we had a little bit of a bear market here. Does anybody remember what happened in March of 2020? Anybody want to recall what happened then? COVID. Yes. So COVID happened in March of 2020, and we had one of the shortest bear markets on record. It dropped 35%, and it got bought up very quickly, right? So we had a bear cycle. And then what happened after that? This thing rocketed, pushed up, kept moving higher. And then 2022, the government printed a lot of money because of COVID, pumped a lot of stimulus into the economy. And what did the Fed say that they had to do? They had to raise interest rates. And that triggered the bear market of 2022. Boom, down we go. Right? But we're still in our Apple and we're still profitable because we bought way back here. So despite a bear cycle, we're still good. And then it climbs, it keeps going. Wow, this thing is just ripping. And then February of last year, we're hearing talk about this thing called Liberation Day and tariffs, President Trump. And what happens? We get a 21% drop, which technically is a bear market. Oh, but hey, we bought this at $44. All right. So I want to point this out. We bought at $44.64, May of 2019. We went through 1, 2, 3 bear cycles, and the price is still up in the 200s. It actually, Apple got up into, I want to say the 280s here recently, but we sold at 200. We're being conservative. We sold at 200, right? So let's take a look at what would happen in that situation. All right. So here's our 25 shares that we bought for $44.64, and we didn't ride it up to $280. We sold it at 200, right? We got out. This was just this was a long-term swing trade for 5 years. So our investment of $1,116, we profited almost $4,000, and our total amount of cash is now $5,000 off of 25 shares over a 5-year period, right? And that's selling at $200, and that's despite 3 bear markets. And you could see, all right, what if we had 75 shares? All right, our investment's going to jump up. It's going to cost us $3,300. But our profit at that point, selling at 200, it's almost $12,000. And you could see that as the number of shares increases, and let's say that you have 1,000 shares and it costs you $44,000 over that 5-year period, your $44,000 is going to return to you $155K over a 5-year period. 3 bear markets. And the reason why I point out the bear market piece is because there are doomers out there who are always calling for the great crash. Oh, it's going to crash 1929, 2008, the Great Recession. Oh, we're going to zero. Okay. That does happen. There are bear cycles in the market. They happen. It's a natural, healthy thing to occur. But go back and look at the SPX chart from its inception until today, and you tell me what happens after every bear cycle. The market not only returns, but it exceeds its previous highs. So the doomers can be fearful and afraid all they want. The math doesn't lie. And in fact, when you get those bear cycles and those huge, massive drops, those are your greatest opportunities. Okay. So wanted to make sure that I pointed that out. But you see here, $1,000 over 5 years invested in Apple, which I wouldn't say that they're not volatile like a Tesla or a Microsoft. They're still a big tech company that does move pretty swiftly, but they're a pretty consistent company in terms of their price action. All right. But look at that return on 25 shares, $1,000, almost $4,000. So instead of buying a TV or a new iPhone, take the money, buy 25 shares of whatever company is up and coming that has strong fundamentals that can grow your money over time. Now, let's look at this with dividends. So we talked about how every quarter a company pays out dividends. And guess who pays dividends? Apple does, right? So if you were holding Apple over that 5-year period, it shows you what you're going to get paid in your dividends. And you can see that goes up the more shares that you own. And so your profit is going to increase, not massively, but imagine if you're compounding this and holding it for 10 years, 15 years, 20 years, 30 years. And don't just think about yourself, think about your kids, your grandchildren, right? This is bigger than us. And you could see the types of returns that you could start getting despite bear cycles, right? And that's what those dividends included, right? And there are tons of dividend stocks that are out there. Now, let's really ramp it up. So let's consider a bull cycle. And what I'm saying by a bull cycle is, let's just assume that the same amount of growth that we got in that five-year period that still had 3 bear markets. Let's assume that we have that same type of growth over 5 more years, 10 more years, and 20 years on Apple, where it grew 35% in that time frame. So check this out. Those 25 shares that were worth 200 in 2025, if we follow that same process, it's now worth 18,000 in 2030, 65,000, 2035. And in 2045, 20 years from now, $430,000. And you could just see as that number of shares goes up over time, and let's just say you had 1,000, you could see how significantly that value is going to grow. It's mathematics. It's compounding. It's the market. Now, because I want to make sure that we're looking at the bear side here, because there might be some of you out there saying the markets don't just go straight up. All right, so here we're looking at adjusting those prices by assuming some significant bear action over the next 5, 10, 20 years. All right. So that previous chart table that we looked at assumed around 35% growth like we saw from 2019 to 2025. This cuts it down to starting at 15% to 12% to 10% compounded annual growth. But you could still see that number climbs, right? Let's look at our 25 shares from 5,000 to 10,000 to 15 to 33,000. And so even if it is a bear market, you're still going to get a return. The return is still there. It's put out there on the chart. And again, you have to pick correct stocks. You have to pick high quality companies. You can't buy trash because you'll lose money. But even during bear cycles or when returns are down, you're still going to be in a position that is better than if your money was just in cash, gaining next to nothing in interest, right? You're not going to be able to get from a money market account or a savings account what you can get in the stock market. All right. Any questions about those tables? And really, here's the key point is you can't afford not to start. And that's what I'm trying to drive home to you, that it doesn't matter how much you're beginning with. Even if you start small, putting a little bit away every month into a high quality company, or even into an index fund, the S&P 500, which returns on average yearly 10%, you're going to have more money if you're disciplined and consistent with it in 5 years than you would if you just put it in a savings account and did nothing. So no matter where you are, the key is to get started.